Now we're over to Power Options, and we can take a look at Stefania's questions. Stefania's first question was, in a long put, what is the strike range in the money and at the money that should be considered if at expiration we do not want to exercise how will the option close? Okay, so I'm going to break this down a little bit. And you also followed up with a question here, what is in the money and out of the money for the put and for the call side? Okay. When we look to do a long put following our default search that Ernie researched here on the Bollinger Bands, the strikes are usually in to at the money. Now this is for the long put screen. This is actually out of the money. But some of these are out of the money. Stock at 36.32, buying in November, 35 put for 490. Campbell Soup, 43.72, buying in November, 43 for $1.95. UPS, 191.36, 190, 740. Okay, so what is the range in the money and at the money? We typically don't want to go too far out of the money. In most cases, Stefania, what do I mean by that? So stock's at 54.42. This December 50, even though it matches the criteria, makes me a little bit nervous. Seems a little bit far out of the money for me. But that also depends on what your expectation is for the position. Let me stick with Campbell Soup. Here's the 43.72 position. Stock's at 43.72. We're looking at the slightly out of the money 43 put. We're going to call it at the money. Okay? And it's got a reasonable price here for 112 days out, $1.88. That's not too bad at all. And of course, the break even, this is at expiration only, is at 41.12, and we're holding the 43 strike. So $2 down, that's the break even at expiration. If it hits 41.12 before expiration, we're going to have a profit on the position. Okay, that's the break even at the worst case scenario when all of that time value, in this case, the full $1.88, has been sucked out of the position. So if at the halfway point, September 27th, Campbell Soup goes to 41.12, that was my break even, right? 41.12? Yeah. So we're going to be a profit of $61. Okay, so that's a third of the price, a 33% return. That's pretty reasonable in that case. Now, to your direct question, this is out of the money. Okay, everything for puts, anything above the current stock price, 44, 45, 46, 47, is going to be considered in the money, Stefania. Anything below the current stock price, 43, 42, 41, 40, that's out of the money. It's all time value. There's no intrinsic value. The calls are reversed. Anything above the current stock price for a call is out of the money. Anything below the current stock price on a call is in the money. Let's take Campbell Soup, CPB, currently trading at 43.72. Now what we're going to do is we're going to go to a different tool, Stefania. Let's go up to the long put, or we can go to the signature tools, and we're going to go to the long option finder. Now what we're doing here is an exercise to answer your question. In general, Stefania, we prefer to go at the money to one or two strikes in the money when looking at a call or a put to buy. Okay? But this also depends on your expectation going forward. What do I mean by that? Let's take CPB, Campbell Soup. All right. So the stock's at 43.72. If I expected a 5% decline in the next 30 days, what this tool just did for us, Stefania, is it went out, grabbed every available put option available for Campbell Soup, grabbed the current price of the option, calculate, of course, how many contracts we could buy based on our investment amount, and then it used the Black-Scholes calculation to show us what these theoretical values would be worth if the stock was trading at our expected price of 41.50 on our expected expiration date. And of course, it's taking the September 3rd expiration, the closest series to it. Why? Because that has the lowest cost, which would result in the lowest return. What do we know about all of these puts in this table, Stefania, except for one? I'm sorry, except for two. They're all at in the money. 44, 45, 46, 243s. We're really going to say these are all at to in the money puts that'll give us the highest return? Where are the cheaper 40 strike puts, 42 strike puts? Well, what it's telling us is if the stock fell to 41.50 based on the cost basis and the time frame we selected, 30 days with 5 days, 10 days, 20 days remaining to expiration, those puts might have a profit, even though they were cheaper, but they're not as high with only a 5% decline that we would get with the at the money to slightly in the money put options for Campbell's Soup. Based on what? The current implied volatility numbers and the Black-Scholes pricing model. What if we expected a 10% decline? We expected Campbell's Soup to drop down to maybe $39, a little bit more than $4, of course. So we're 10% decrease in this position. Now what do we see? Now you start to see those cheaper out of the money puts for the same expiration. And they have a high return, but you needed that larger movement in order to see the decline. So buying puts, Stefania, buying calls, your first question, what is the strike range in the money and at the money that should be considered? That really depends on your expectation of how much the stock is going to decline. Why in the search, that search that I showed you, the Bollinger Band search, were most of them at the money to slightly in the money with that one outlier that was way out of the money? And it's because in normal market expectations, you're expecting a 5% decrease, 3 to 5% decrease or increase in the stocks. Normal market conditions, a declining stock. We're not talking about a stock that has gone through earnings and we're expecting to collapse 10, 12, 15%. If you have a really high bearish expectation for the market as a whole, Stefania, or a particular stock you're looking at that you're very bearish on, use this tool, the long option finder. You can get it under long put or long call or under the signature tools tab. Put in your stock and then put in that expected price. If you think it's a 7% decrease, calculate that out, 10% decrease or more, and you'll be able to determine which put will give you the best bang for your buck if the stock is trading at that price at expiration. Now, is it valid? Well, a lot of these I'm going to tell you are extremely valid. How do I know that? September 3rd, 42 puts. Current price is 65 cents. So yes, I can buy 30 contracts. I agree with that math completely. On 8/27, roughly 5 or 6 days before this expiration, on September 3rd, the weekly expiration, the stock's at $39. My 42 put would be worth $3. Well, that makes absolute sense, doesn't it? It's intrinsic value. It's going to be at least $3. It might be more. Now, am I saying the stock's going to be trading at 39? No. But I'm saying if it hits that, yes, this number makes perfect sense. It'd be near intrinsic, maybe 305, maybe 306 with 4 days to go. But again, with a 10% decrease, out of the money, cheap put would give me the best bang for the buck. This is every option. It's looking at the Decembers, it's looking at the Januaries, it's looking at 2023, it's looking at all of them. It's only showing you the top 10 with the highest return. But again, if we only expect a 5% return down to 41.50, it's going to be showing us the at and slightly in the money puts that give us the best return. Now, we're not talking about 100% returns. You don't normally see that with a 4 or 5% decrease on a position, unless implied volatility spikes, which it might. You'll get a little bit more bang for your buck, Stefania, in that case. But it's not so much about what is the best structure for a long put. It's more about your expectation on an individual stock. But normal non-weak markets not playing an earnings event, we are not expecting a 10 to 12% decline over 20 or 30-day period. A trending downward stock you think would lose 3 to 5%. A trending upward stock you'd feel would gain 3 to 5%. It could gain more. And that's why in those searches, we're looking for right at to just slightly in the money, because those are the ones that give the best return with a normal standard declining stock or standard increasing stock for a call of 3 to 5%. Anything beyond that would be gravy. Okay, there would be better strikes, but you'd still be able to profit here in that case. But we can see here that those at to just slightly in the money calls with only a 5% decrease in this case are giving us the best return across the entire option chain. No, Fernando. Okay, Fernando says why put slightly in the money far in time 1 year has a delta of less than 0.5. Oh, that's just because of the extended time frame. That's all. Okay, it's you'll see that often when you go out in time because the delta is based on the Black-Scholes pricing model. In a sense, it's based on the same factors that are used in the Black-Scholes pricing model. Because what is delta saying? It's saying, okay, based on the expectation, Fernando, if the stock moves 1 point, what do you expect the change in delta to be? And so when you're looking 1 year to 2 year out calls or puts, Fernando, what happens with the Black-Scholes pricing model is it sort of loses its efficiency when you go further out in time. I'm going to be honest with you. And it's a known flaw of that calculation, but it's still used. Okay, sometimes Monte Carlos are used for the probabilities and things of that nature. But as far as the Black-Scholes pricing model, saying what is the expected value of this option if the stock changes by 1 point, which gives us the delta. But when you're calculating that on, oh, sorry, folks, something that's a year out in time, it's a lot. It is not as efficient in that case. So, Stefania, one more. You've got one other question here, and I wanted to address something else real quick for a better view. Let me go to the option chain here. This is just following up with your other question. Here's the option chain. Campbell Soup at 43.72. These are the puts only because I came from a put option. All these ones highlighted here, 44, 44.5, 45, so on and so forth. Again, with a put, anything that's higher than the current stock price is in the money. Anything below the current stock price is out of the money. On the power options chain, these highlighted here are the in the money. So you see that little blue background, gray background, gray-blue background. Now to the call chain. Calls are reversed. Anything below is in the money. It has intrinsic value and time value. Anything above is out of the money. It only has time value. The stock has to reach that point before it gets any intrinsic value. Okay, so calls higher than the stock price are out of the money, lower is in the money. Puts are reversed. Higher than the stock price is in the money, has intrinsic value and time value. And anything below the stock price on a put is out of the money. Now, your second question. And I don't even need to move. Let me go to a different month. Let's go back to, we were looking at September 3rd series for Campbell Soup here, and these are the puts again. You'd ask me a question, using implied volatility as a parameter, historical and current, how to set the proper IV and calculate the probability of the success for the put call. Okay. We don't talk about the equation of using implied volatility to calculate the probability because we're doing it for you. This is the theoretical probability that the stock will be trading at or above the strike price of a put or a call at expiration. Not at any time, Stefania, but at expiration. Okay, so we're doing that math for you. This is probability above. So I'd be looking on a put for probability below. I should change that column. But let's just go to the long put search again and talk about something else. And I'm going to add in percent probability and 2 other columns I think we need here. So implied volatility is 1. I'd be looking for the percent probability below. Or is it there? Probability below. But there's something else I'm really more interested when I'm looking at buying a call or buying a put. There it is. Percent to double. The theoretical change we need in the stock price in order to have our option price double. Why am I saying that's more important than the probability below? So again, in this case, let's take our Campbell Soup here. 43.72, 43 strike. And as Fernando mentioned, it's right at the money. So we're looking at about a 44.4% probability that it's going to be below the strike price at November expiration. What's more important to me is this, because this is showing me at expiration, all the way out to November in this example. What I'm more concerned about is what change in the underlying stock price might I need to see my option bid price double to get that 100% return. And that's 7%. So again, it's pretty high, but I'm focusing more on the percent to double as I am the probability when considering buying a call or buying a put. Because I'm not planning on holding this anywhere near to November expiration. If I'm trading this Campbell Soup position, this November 43 put, is because, as I just showed you with the long option finder, is because I have the expectation that this stock is going to fall 5, 6, or 7% in the next 30 days, and I'm going to be out of this position for my 60, 70, 80%, maybe hopefully 100% profit. Let's say 60 to 70% profit prior to November expiration. I'm not going to hold it all the way to November expiration, because then I'm going to lose just this time value. If it's staying right above 43, all I'm doing is losing time value on a daily basis in that case. Okay, so although we show you the probability, having a higher probability, going deeper in the money, doesn't mean it's a better trade, because you're not concerned so much about the probability. Because remember, the probability is only at expiration. What you're more concerned with is, am I getting a position that is a good bang for the buck if the stock gets near my percent to break even in that case, or even drops only 4 or 5% in the next 20 to 30 days, so that where I can be at a profit, and does that profit match my goals for this portion of my portfolio? That's what you're looking for. So again, to recap, we generally suggest that you go, I'm sorry, I meant to go to the search there. We generally suggest, Stefania, that for buying calls and buying puts, you want to be at to slightly in the money. And that's because, as we showed with the long option finder, I have 2 long put searches, I'm sorry. What we showed you with the long option finder was that when you have that subtle decline of 4, 5, 6%, those at to out of the money options are going to be giving you the best bang for the buck and the best return. The cheaper out of the money options, it hasn't had enough movement yet to where it's profitable and to where it's hit those strike prices. But that being said, if you're expecting a 10, 12, 15% decline on the stock or on the market, and you're looking to use SPY or QQQ puts as a hedge, then you could consider out of the money. You'll get a little bit more bang for the buck. You're absolutely right. But if the stock doesn't fall as much as you expect, it only falls 5 or 6%, you could be at full loss in those positions because it hasn't breached the strike price yet. It's still out of the money and going to zero value. What I mean by that, if I expected that 10% decline down to 39, and I chose the 40 strike put, but the stock only dropped down to 41, that put still out of the money, has no intrinsic value, and is still declining. It's losing that time premium. It needs to drop another point before it goes in the money. Now it needs to drop more to give me the cost back that I paid for the position. And that's what we're looking for. And then, of course, the implied volatility that I mentioned there, looking at the search, what we tend to focus on more is this percent to double. We typically want a lower percent to double range, provided that the strike, I don't want to forsake what I'm looking for in general with the other criteria and force this to only a 1 or 2% to double. Which options have a 1 or 2% to double? The options that are deeper out of the money, that are 10 cents and 20 cents. There's just a small movement in the option, then just needs to go ahead and only needs a 1 or 2% movement to go from 10 cents to 20 cents. Okay, but some of these are reasonable and some of these are not. This one's a 13%. This one's a 24%. There's a lot of premium here on CPNG, and that's because earnings are coming up in 12 days. Same with Lordstown Motors at 32. High implied volatility, earnings coming out in 12 days. Colgate came out today, 8.4. That's not bad. Kraft Heinz 38.47, slightly out of the money, put at 37.50. I tend not to bet against Kraft Heinz, but it'd be interesting to see what happens there. Fernando brings up another point, and this is a battle of 2 different concepts in a sense, Fernando. Fernando says when you buy an option, buying a put, buying a call, as we've been talking about, is not always convenient to choose the expiration as far as possible. You have more time for movement and less time value, and you can liquidate when you want. What we were talking about before, and let me just clear the settings here. I'm going to look at all expirations. We're going to look at 1 strike out of the money for just CPB. And I want to organize by date. It always helps, doesn't it, Fernando, if I do that correctly? All right, so I'm changing the expiration date, and I change it lowest to highest. Okay, so most of these are very similar. We're talking about a difference. Some are 43.5, some are 43s. Fernando's comment is to what we always talk about with the three core principles of options trading. And one of them, of course, is the at-the-money bell curve, that when you're selling, you want to be at the money. When you're buying, you usually want to be slightly in or slightly out of the money. Usually for a put, I want to be slightly in or out of the money. I'm slightly in the money. Okay, 1 or 2 strikes in the money to at the money if I got the right price, whether for buying for speculation, Fernando, or buying for protection. Now, I'm going to stick with my 43 strikes. 28 days out, the 43 strike is worth 65 cents. 43 strike put, slightly out of the money is 65 cents. I doubled the time, it's not quite double the time, but we go 49 days out, we're not quite double the cost. It's not 135, it's only 115. In reality, we're not double. Now, 5 times the amount out in time, November, 112 days from 28, roughly 5 times, okay, a little bit less than 5 times the amount of time, but the premium is only $1.30 more. It's only about 3 times, not 5 times. Okay, now we go all the way out 539 days. Oh, let's go 238 days, sorry. 28 days, the 43 strike is 65 cents. 203 days, 9 times the amount out in time, almost 10 times the amount out in time. And the call, the put premium, is nowhere near 10 times the price. It's only about 4 times the price. Okay, and this is, so we talked about the ATM bell curve, and this is the time decay curve, that when you're buying 120, 160, 180 days out in time, okay? So what ends up happening is if I buy 160 days at a time, the stock's not doing one, I'm seeing less and less time decay. But when I get in those last 30, 15, 10 days, it's drastic, okay? So Fernando's saying, why not buy as far out as possible? Because then you can do maneuvers and then you can do adjustments. And you know I agree with that, Fernando, because that's how I set up the married puts in a sense. But what I'm also answering for Stefania is more along the lines of questions of speculation on a shorter term type of trade to look for a return on the position based on the questions that they asked. As a general rule, I'm at least going 150, 160 days out in time. I'm not trying to force it to always the farthest, because normally I'm looking, again, to buy a put or buy a call that I expect is going to move in the next 30 days. So I'm probably going, as you saw, 90, 100, 150 days out in time. So if it doesn't move in the amount of time I expected, I still have time to react, as you mentioned, Fernando. What I'm not doing here is showing this as a longer term trade. Whereas when I'd buy a year out put or perhaps a 2-year out put, it'd be in a married put position on a stock I'm planning on holding long term on the position. When I'm buying a call, it's for speculation of a market movement in the near term. Maybe in the next 30 days, that 5 or 6% decrease, and I'm using the long option finder to see which one's going to give me the best bang for the buck. I'm not planning on continuing to trade it. I'm looking for a 20 to 30-day return. But that's what I assumed based on the questions that came in that case. Okay. Now, last little piece for Stefania I have to address. I forgot, I skipped it on the first one. To our 43 strike put for August. It wasn't August, it was September 3rd, right? Let's go back to our profit and loss chart for that position. This is the one we looked at. And this is the one close to the same one we saw with the long option finder, expecting a 3 or 5% return. This, remember, Stefania, is a slightly out of the money put. We're below the current stock price in this case. If the stock stayed at 43.72 between now and September 3rd expiration, and we made no adjustments, as Fernando was talking about, we didn't try to roll it in, we didn't try to sell a put against it to lower the cost basis because the trade's not going as we want. The stock's here at 43.72. The put expires worthless. It has no value. We didn't do any adjustments leading up to it. Our put is still out of the money at 43 with the stock trading at 43.72. If the stock moves up, same thing. Our put's going to 0. The put expires. If the stock drops to 40, where we'd have a very good profit on this position, we'd have $3 of intrinsic value on our option. We paid about 93 cents for it, so we'd be looking at a profit of a 210. Okay, a little bit less than that, 207 on an investment of 92. A very, very strong return, Stefania. But if you didn't actively sell to close the put, You can sell to close it at any time between now and expiration. If you don't actively sell to close the put or sell to close the call, then your broker assumes that you wanted to exercise that option, meaning that you wanted to exercise your rights you own for purchasing the September 43 put, which means what? On September, might be the 7th, because if September 6th, which would be the Monday following this Friday expiration, is Memorial Day, Labor Day weekend, then the markets might be closed. So if the 6th or the 7th, in any case, what would happen when you wake up Monday morning, you'd be short shares of CPB at $43. Now that's okay, because the stock's still trading at 40. You could buy the shares of stock at 40 to cover your short, and you'd still get the $3 back. But if you don't actively close your put option or your call option that's in the money, your broker assumes that you wanted to exercise your rights for owning that option. In the put, that means you're forcing someone to buy shares of stock from you at 43. If this was a married put position for me, where I own the stock and own the put, my broker would just be selling my shares of stock at 43. If you don't own shares of stock, and this is just a long put purchase, you have to fill that requirement. You're now short shares of stock at $43, but you can do that in the market. You typically want to sell to close an in-the-money put or sell to close the in-the-money call when you hit your targets for the trade prior to expiration, or if you're going into expiration, you're in the money and you don't want to put up the cost or don't want to put up the margin fee for being short shares of stock, you sell to close it before Friday's expiration. You can do that at any time. What most long call and long put buyers do, they don't go near expiration. They're expecting an event or the stock to fall in the next 5 to 10 to 15 days. So they're going 30, 60, 90, as Fernando and I are talking, 90, 100, 120 days out. And when they've hit their desired return because the stock did decline in the direction they wanted you to go, then they just sell to close it. They have no interest normally in owning this, buying the call to own the stock, or buying the put to be short the stock. This happened to me, Fernando. Fernando does come up with a question on that one. Let's clear my drawings and let's go back to the profit and loss chart briefly here. Fernando asked in this discussion, if the broker assigns you, so we're going to say that my stock fell to 40. Remember, we're short the 43 strike right here. So we're in the money by 3 points and we didn't sell to close it. Does the broker assign your short shares, but you are not allowed to short the position? Then you get into trouble. It's not too bad usually. Okay, this happened to me. Believe it or not, in the early days of radioactive trading, I was in Texas Instruments, TXN. I was in a married put position. I owned 100 shares of TXN and I had whatever strike put I had here. Stock was trading down in this range. Earnings were coming up and I wanted to protect myself, Fernando, for a large drop, a potential drop in the stock. So what did I do? This was out, let's say we're in April or maybe May, and this was out to September or October. This is my married put. It's out to September, October. I'm in April or May. Earnings are coming up. I bought a near term, I think it was a May expiration if I'm not mistaken, but instead of using a standard May expiration, I used a weekly expiration on TXN. It was a May 6th or a May 8th expiration. I bought an extra put, okay, and to do income method number 12 for the stock to decline. And the stock did decline. I was looking at a profitable position. I'm in an IRA account. Now, what happened at May 8th expiration, because I thought I had the May 20th extra put. I have a September put, and I thought I had a May 20th put, but I had a May 8th. I start getting emails on Saturday, May 9th, that there's an error in my account, that I made an invalid transaction. They knew that my September put was linked to my shares of TXN stock. They treated this just as a separate long put that went through expiration in the money, and they shorted shares of stock for me in an IRA where I can't be short shares of stock. So what did they do, Fernando? They gave me a penalty. I think it was just that they closed it for me because I wasn't allowed to be short. They closed it for me on market on Monday, and it ended up being okay. It was still about intrinsic value. I mean, it was a little bit less than intrinsic value, what I could have gotten had I sold to close it on May 8th. They did that. I got a penalty, a couple $100. I can't remember what it was, $200, $300. And then I was on probation for 4 months. Now, what does probation mean? It means I could still do covered calls in that IRA account. I could still do married puts. I could still do collar positions because everything was covered. What I was not allowed to do for 3 months or so, 4 months, was buy just calls or buy just puts. That was my penalty. I was in timeout. So that's what happened to me because I forgot to cover it. I had the wrong expiration date in my mind and I got closed. I was lucky though, in the sense, how was I lucky? Well, I got the fine and I was put on probation in that account. But when they shorted the shares of stock for me, they themselves couldn't close that short share position over the weekend. They had to wait till Monday. If TXN had gapped up on Monday for whatever reason, good news or something, I would have lost more money on that transaction. Thankfully, it stayed where it was. It dropped about 50 cents at the open, so I got a better price than I could have gotten on Friday, if I'm not mistaken. But I don't call it a better price because I had the $200 and $300 fine, Fernando, and the 3 months, 5 months of penalty, and being at the doghouse there, not being able to do uncovered positions until that probation period